From entrepreneur to homeowner, the ultimate guide to bank statement loans for real estate. Hey, what's going on, everybody? It's Jeff Trevarthen, Jeff the Mortgage Pro. Thanks so much for watching my video today. I really appreciate you guys very much. Let's jump right into it. Let's talk about bank statement loans. These are loans for self-employed people, self-employed borrowers. That means that you have your own business, or you're 1099, or you're a contractor. Those are all different definitions of a self-employed borrower. And this is a type of loan that you can get outside of the normal conventional loans that you can actually buy. So here's where I would say you need a bank statement loan going forward. And let's ask you the question, like, do you have a really good accountant? Do you make a lot of money in gross income, but then you have a lot of expenses that you use to write off? And then at the end of the day, your net income doesn't show very much on your tax returns? Well, if you're like most self-employed borrowers, then the answer is probably yes to that. I know that I am one of those people as well, and that's okay. We want to pay as little tax as possible and make as much income as possible, but it makes it really hard to qualify for a mortgage when you write off most of your stuff going forward. So enter the bank statement program. These came in 5, 6, 7, 8 years ago now, so they've been going around for a while. They're called a non-QM loan, which means non-qualified mortgage. So they don't follow the same guidelines as Fannie Mae and Freddie Mac do, but these are opportunities for you to be able to get a mortgage and get into a property as a self-employed borrower and to be able to purchase the size of the property that you should probably be able to qualify for. And it's not going to be the same as if you were going to use a conventional loan and having all those expenses counted against you when you're buying a property. So let's look at some of the different options or different ideas when you're trying to do a bank statement loan for a self-employed borrower that can definitely help you out. And if you are a self-employed borrower, you need to reach out to me because these are some of my favorite loans to do. I love people who are entrepreneurs and they have their own businesses, and this is such a way to go. So people like realtors, financial advisors, in a lot of instances, small business owners, even large business owners, if you are self-employed, this is definitely the way to go. So let's look at some of the guidelines here. We have loan amounts all the way up to $4 million, and we probably can go higher than that if you really needed to. We can do these bank statement loans for purchases, rate and term refinances, and even cash out refinances as well. And on top of that, you can do a bank statement loan for a HELOC as well. I don't think anybody knows that. There's one or two investors out there that actually will allow you to do a bank statement loan for a HELOC if you really need it. So at the end of the day, that could be your ace in the hole if you really need to get some money and use a bank statement loan to get that. So we can use either 12 months or 24 months of your personal bank statements or business bank statements. Now, typically, we're going to be using 12 months of your business bank statements. If we want more stability, if you want to show more stability in your income, then you should definitely do the 24 months worth of bank statements. So that's the last 2 years of bank statements to be able to help you qualify for this. And what we're going to do, we're going to look at all the income that you have coming in, and we're going to use an expense factor ratio of typically 50%. So for example, if you have $100,000 in deposits coming in one month, we're going to divide that in two. That means that you have $50,000 of income coming in according to our bank statement calculations to be able to qualify that. Now, let's say your expenses are not 50%. How could you get around that? You could have a CPA write a letter saying that my expenses are only 25% of the revenue that I bring in, and that helps us lower that expense factor ratio, which means it's going to increase your monthly income that we can use to qualify you for your new home. So some cool things that we could do to be able to help you qualify with this bank statement type of a transaction. These are for 30-year fixed loans, and there's definitely ARMs available, 5-1, 7-1, even a 3-1 and a 10-1 that I've seen sometimes, but those are the most common ones, the 5-1 and the 7-1 in terms of ARMs. There's definitely interest only available. Since this is a non-QM mortgage, interest only is definitely something you can look into. There's probably a rate adjustment or a cost adjustment to the cost of that loan, but at the same time, interest only can help you minimize your monthly payment every single month. So we can always run those options between, do you qualify for interest only or do you want to have a fully amortized payment? We need as little as 3 months reserves. Typically, we like to see a little bit more, but for the most part, 3 months is going to be the very minimum. I've seen upwards of 6, 12, 18 months in some instances, depending on the loan size. So reserves is just 1 month worth of principal, interest, taxes, and insurance monthly payment. And, what we can use to qualify that for a reserve is we can use extra cash that you have in the bank, say in the bank beyond just your down payment and closing costs. We can use 401ks, IRAs, stocks, bonds, all sorts of different things that we could use for reserves. Now, this is just a calculation of risk. It's not something that you have to actually spend the money on. It's just a calculation of risk that we use as lenders going forward. We have up to 90% loan to value. That means you put as little as 10% down when you're using a bank statement loan to buy a property. So this could be pretty cool if you're buying a big property and you're only putting 10% down. If you have a really good cash flow, that's definitely something that you could look into, is putting less down into equity when you're buying your property. When you're doing cash out refinances, typically 75% is going to be the max, up to 80% in some instances, but keep an eye out for that equity piece when you're doing a loan. I can help you out and guide you in that. If you're a first-time home buyer, that's totally okay. So as long as you have the history of being a business owner or you're self-employed, we can definitely use that to help you show some strength in your file, even though you are a first-time home buyer. So don't worry about that if you are. Credit score is down to 640. Typically, we like to see better credit. The lower your credit, the worse the terms are going to be. So higher interest rates, probably more cost to be able to get these types of loans. So keep an eye on your credit. Try to keep it up as best you possibly can, but we can go down as low as 640 on the bank statement program. And then lastly, the piece that I want to mention is that you don't have to be self-employed for 2 years. And it could be 18 months. I've seen it in some instances, lenders will make an exception for like a little over 12 months. So typically you need at least a year, but you don't need the 2 full years in a lot of instances. As long as you have a 12-month history, you're probably going to be able to be good. It's not going to be the best pricing and the best terms, but at the end of the day, you can still get a loan because you can always refinance that loan down the road. So again, if you're self-employed and you are trying to buy a property, but you have a really good accountant that you use to help you pay less in taxes every year, then reach out to me. This bank statement loan is going to be a big game changer for you to be able to qualify for the property that you deserve. My calendar link is down below, and I look forward to chatting with you guys on the very next show. Have a good one, guys. Talk to you soon. Bye.